You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again for TWIFO, This Week in Futures Options, a program where we break it all down. Is it going to be ags? Is it going to be metals? Is it going to be rates, equities, energy, something else, crypto? You never know. FX, what's going to sneak onto the show. That's why you have to tune in every week. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network upon which you all are sucking down the bandwidth these days. It's okay. There's more where that came from. If you like what you hear, throw some stars, a like, a comment, a rating, whatever your platform lets you do. It's available pretty much everywhere you can get audio, not just your iTunes and your Google Podcasts, but your YouTubes, your Audibles, you name it. It's available everywhere. So if you like what you hear, stars, likes, comments, whatever they let you do. It does help folks get it, including via our mobile app. You can throw some stars in the app store there as well. And of course, if you want more content, and who can blame you, theoptionsinsider.com/pro, the place to go for a lot of exclusive stuff, 200 plus exclusive hours of content there right now as we speak. More on the way every week, listeners, live access to everything we do, priority message and question asking, all sorts of fun, giveaways, whole bunch of fun, theoptionsinsider.com/pro, the place to go as we go around the horn, see who's joining us this week in the old CME Group hot seat. I am pleased to welcome on once again our old friend, Mr. Dan Gramza from Gramza Capital Management. Mr. Dan, welcome back to the show, sir.
Well, thank you, sir. I'm excited about being here and exploring these unusual markets, I would say.
Yeah, the Fed
it's been a very interesting week, Mark.
Injecting a little life, maybe a little bit of tumult into the old market. So let's get to it, listeners. A little bit of the old movers and shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everyone, welcome to the Movers and Shakers Report, the portion of the show where we break down everything lighting it up to the light side, a.k.a. the upside, and to the dark side over there at CME Group. this week. Mr. Dan, you know the dance by now. Where should we begin our journey this week, sir?
I think we should start on the light side.
All right, to the light side we go, listeners. And looking at this heat map here, this report that we put out for you folks right before the show, not a lot of light side to be found here, listeners. I think if we scroll in, looks like we could maybe eke out a top 10 to the light side, but that would be just barely. And the bottom half of that top 10 would be, up 0.03%, something along those lines. So it is, I'd say 85, almost 90% red this week, listeners. The Fed taking a lot of steam, a lot of air out of the markets out there this week. So let's go to the light side first. And again, you'll see it number 5 really quickly. How light things get even at number 5 this week, listeners, because number 5 is our old friend WTI. Pretty much a rounding error this week, up 0.62%. Normally, that would not be enough to get you even remotely into the conversation on the show, but that's enough this week to get you to the number 5, because that shows how few names there are in the light side and also how light the light side is, because 0.62%, and you're already in the top 5. Intriguing. Number 4, feeder cattle, up 0.64%. And they do some paper out there, more than you might expect, 10,000 contracts. I mean, it's not 3-month SOFR or the old euro dollars, but it's more than you might expect for feeder cattle. Number 3, to the metals. So we went from energy to livestock / ags, and then now to the metals, listeners. Number 3, palladium, up 1.21%. It was number 3 in the same direction last week, up about 3.87%. So up about 5% over the last couple of weeks. Before you get all hot and bothered, 97 contracts on the tape for palladium this week. Number 2, staying in the shiny stuff, going out to platinum, up 2.16%. Again, before you get all excited, 1,000 contracts on the tape for platinum, so not a ton of paper outside of the top couple. Really not a ton of paper on the shiny stuff. Speaking of the shiny stuff, we're staying there for our number 1 light side mover this week, listeners. It's silver, up 2.66%. It was number 4 in the other direction last week, off nearly 2%, about 1.87%. You know the deal with silver. On a given week, it's going to be somewhere around 25,000 contracts. That's pretty close to where it's hanging out right now. So we could certainly sink our teeth into silver and indeed the shiny stuff out there, given the fact that we are coming off a Fed week, might be appropriate. Now, to the dark side we go, listeners. There's a lot of darkness. I mean, our top light side percentage mover was silver, 2.6%. We are starting at the bottom of our light side, off 4.69%. That gets us off to the soybeans, listeners. Again, off 4.69%. You know the beans, they're a pretty active complex, pretty active product. You have corn usually leading the dance in the ag space, but soybeans right behind it. Corn's going to be somewhere around 400,000 contracts probably. Right now, soybeans, 321,000 contracts. So nothing to sneeze at out in the beans. We could certainly hang our hat out there, and we have in the past. They've been kind of favorable for collars in the past. Is that the case this week? I guess maybe we'll find out. Number 4, staying in the beans, but going to soybean oil this time, off 5.06%. And again, 73,000 contracts on the tape there, so no slouch there. Roughly 3x silver, so certainly some paper to be mined in the soybean oil as well. Number 3, these discretionary sectors from the S&P are becoming more and more on our radar these days. This week, it's the consumer discretionary sector. So if you're wondering what components of the S&P are giving up the ghost the most right now, allow me to present number 3, the consumer discretionary sector, off 6.17%. Again, just futures there, no options yet, so can't sink our teeth into those, but they are starting to become more interesting to us going forward. Number 2, back to the ags, this time to the dairy subset with Class 3 milk, off 7.39%. It was number 2 to the same direction last week, off about 4.25%, so a rough couple of weeks for the dairy complex. And again, there's some paper to be had, 2,200 contracts, so it's not nothing. It's crypto adjacent, shall we say, but not a ton of paper either. And then the number 1 dark side mover, staying with the ags, it is oats, listeners, off 11.1%. That is also our biggest percentage mover on the week. It was number 3 to the same direction last week, off about 2.3%. And again, you know the drill with oats, 13 contracts on the tape right now, so not a lot to parse there. But since it is our number 1 light side mover this week, in fact, it's dominating most of our light side this week, makes sense. It's a Fed week. I think we have to start in the metals first.
Werewolves beware.
It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everyone. Welcome to the land of the shiny stuff. Occasionally we get base. I don't think we're going to do that today. Go into your seeingmegroup.com/TWIFO page, listeners. And once you're in that asset class drop down, you're going to go almost to the bottom of the list, one above it, to metals. And then once you're there, you're going to go into precious. Where we start is anyone's guess. Mr. Dan, I'll let you pick. It's not on our list, but a Fed week, we also probably have to talk about gold. So where do you want to start? Silver or gold this week, sir?
I'd say we should start with silver.
All right, silver it is, sir. So go into that drop-down, listeners. Go down 2 slots to silver. Silver hanging out right now, listeners, about 23 3/4, up a little over 1/3 of a point, or about 1.5%. Just this week, and again, not surprising that a good chunk of the move coming post-Fed this week. Mr. Dan, what is catching your eye out there in the number 2 shiny stuff, a.k.a. silver, sir?
Well, what's interesting about it, Mark, is it seems to march to the beat of its own drum. If we look at how it's performed in the past, and I think if you're going to look at those precious metals, silver is definitely one to pay some attention to. It can have the ability to lead the complex. So, and I think that's some of the action that we're seeing today. It was softer earlier today, for example. It did firm up. It's getting near, but not there yet, to yesterday's highs, and it really had a significant drop. What's also interesting is that, silver has some unique characteristics in terms of even industrial demand. And I think that has an impact on some of the price action that we're seeing here for that market. If you're on the long side for this market, what you'd want to see ideally by the end of the week is for it to close above $24. That would be the right kind of rhythm that you'd want to see going into the weekend. And then 24.25 would be the next target, and that would something that you'd want to see by Wednesday of next week. On the downside, what you don't want to see in silver is you really just don't want to see it visit today's lows. That's around $23. If we're going to see this momentum continue, you don't want to revisit those lows. You want to see this momentum carry us higher. Now, if we don't see that movement above $24, look for a sideways move in our friend Mr. Silver.
All right, let's see what kind of move we are getting out there in all things silver, listeners. Like we said, about 25,000 contracts, actually about 23,000 right now, listeners, on the tape. And 32% of that coming in the October contract, listeners. That has, roughly 5 days to go. So goody, we're talking 0 day in the metals now as well, listeners, which they do have a lot of weeklies out here now. Let's add up the percents as we like to do in the others. So you got 32% going up in the October contract. That has about 5 days to go. 12.5% is expiring in about a day. So you're already at close to 45% right there, listeners. So metals kind of trading a little bit like an equity right now in terms of all near dated all the time. You haven't usually see a lot of longer dated upside paper in the metals. So intriguing stuff out here. In the October contract, again, vol with 5 days to go, kind of a bit of a meaningless number, but it's at about 20.25 right now, off about 1.1 points. If we go a little bit farther out, let's say to the November contract that has about 35 days to go, the vol out there about 21.70, so not substantially different, about 1.5 points different out there. That's a decent amount of vol for the metals, all things considered, but not explosive. In terms of skew, the puts no one cares about. They're flat to the at-the-money last week, flat again this week. The calls last week were nearly 4% bid. Now they're 2.7% bid. That's kind of the structure you'd expect, maybe a little bit more of a discount to the puts, but a bid to the calls is kind of the way the shiny stuff tends to trade. It gets more pronounced if you go out a little bit farther. If you go out to February of next year, listeners, the puts there are 3% cheap and the calls nearly 8% bid. So that looks a little bit more like the structure we would expect in the shiny stuff. But in the near-dated contracts, not a heck of a lot of anything, really. A slight bid to the calls and a flat to slight discount to the puts. So again, maybe kind of showing you we're hanging out at a bit of an equilibrium level, at least for silver right now. The big dog this week, again, with the slight bid being to the upside, no surprise that it was the 24 calls going out in about 5 days, leading the dance with about 1,300 contracts. The big day was Tuesday, 900 and change on Tuesday, mostly opening. The rest kind of scattered throughout the week. So a lot of paper going up heading into the Fed announcement, which is interesting. Usually you see it maybe the day of or the day after. People keep their powder dry. They wait for the announcement, then they put on the big paper. In this case, most of it going up the day before, which is somewhat strange. Let's just see really quickly any other interesting and or aberrant paper. Usually you go farther out, you see some interesting stuff, but not exactly the case. It's a lot of what you'd usually expect around at the money puts and calls going out pretty much in a few days. You got number 2 is the 23 puts, 600 of those. The big day today, nearly 300 of those. So since we're talking shiny stuff, let's get out to the big dog in that complex, which is gold. Dan, it's hard to talk a Fed week without talking a little bit of the big dog in the shiny stuff complex. Gold hanging out right now, 1921.9, off about 6 points or about 1/3% just since Monday. So obviously below, but not that far below that critical level of 2,000. What's catching your eye in the big dog of the shiny stuff this week, sir?
Well, when it comes to gold, again, I think it's marching to a different beat than what we saw with silver. It's when I think of gold and silver, I think of them as an excuse market. These are markets that we're not seeing really moving because of supply and demand. We're seeing a market moving when it has an excuse. High inflation, weaker dollar, maybe Fed action that we're looking at. It needs some kind of fundamental to create this idea of movement towards value, because that's where it's supposed to fit in, the concept of value, that it's supposed to be stable in times of uncertainty. Well, the dollar is kind of a mixed bag if we think about what's going on with that. We've seen it getting stronger. We've seen it getting weaker. Today it's a bit weaker compared to the currency complex. And we're seeing gold, a little bit weaker in that regard. And it's the opposite of what you would really expect to see here. But we're not done for the day. Can it give us a rally? And if it can, what are some of the challenges, I think, when we think about gold? And they go right up the line about every $10, $19.50, $19.60, $19.70. That $19.70 would be important for us, and you'd want to see, if you're on the long side or bullish that market, you'd want to see it closing above that by Wednesday of next week. Right now, how do people want to go home tomorrow going into the weekend? Are we going to see this downward pressure that we're seeing? It's a little bouncy off of these lows, but nothing too dramatic. So is there an excuse to drive this market? Are we going to see a weaker dollar that may cause some capital flow towards a gold market? I think it's kind of 50-50 here, and this really implies on current structure kind of a sideways move, I think, for Mr. Gold.
A sideways move for Mr. Gold. You're not ready to give it the big adios just yet, Dan, to use
No big adios.
Use another one of my favorite sayings of yours out there for Mr. Gold here.
Not on this one.
not yet. Not yet, anyway. He's always ready to give the big adios, but not quite yet.
Yeah, true.
So let's go out and see what we're seeing out here, listeners. And a decent week, not perhaps as action-packed of a week for the big dog of the shiny stuff, as you might expect for a Fed week, a little over 200,000, about 205,000 contracts. You might expect 250 maybe on the tape, if not more, given the kind of week we had. And again, gold doing its best equity approximation right now with 28% of that paper going up in the contract. Again, the contract that expires in 5 days. You add in the contract expiring tomorrow, that's almost 9%, and then 1%. So you're talking almost 40% of the paper expiring within 5 days. So again, metals starting to look and act a little bit like equities, at least from an options flow perspective. What is the vol in gold right now? You don't come to gold for vol, and that's the case. About a little under 8.5 for that October contract going out in 5 days. That's off about half a point. So again, that makes that silver vol around a 21, 22 seem explosive. But gold, again, never been a bastion of volatility. Skew-wise, again, nothing really to speak of. The put's flat last week. The call's 2.5% bid. This week, the put's 1.5% cheap. The call's roughly 2% bid. Let's go out a little bit farther to see if we can see more of that traditional metals setup. And the answer is kind of. If you go out to the beginning of next year, you see the puts in January and February, roughly 2% cheap, and the call's about 5% bid. So slightly, but we've seen metals get far more bid to the upside and the puts far more discounted in the past. So again, maybe showing that we're vacillating around a little bit of an equilibrium, at least from an options outlook perspective right now. No one's scrambling to gobble up the upside. No one's certainly scrambling to buy the downside, and they're not really scrambling to crush the downside either. So kind of a little bit of equilibrium out there. The big dog this week looks like it was actually out a little bit farther. It was in the November expiration cycle. It was the 2,000 calls. Again, I said, listen, that 2,000 strike, it just has some magnetism for traders of gold. They love it. They can't get away from it. 2,000 calls in November, going up 4,500 times this week. Almost all of that yesterday. So that kind of gets back to what I was saying about the silver contracts. My little bit of surprise there. We don't usually see the big day being heading into the announcement. Usually it's the day of or coming out of it. And that's what we're seeing with gold here. 3,400 contracts on the tape yesterday, mostly opening. So a ton of opening paper yesterday on the 2,000 strike in November. Let's look here really quickly and see what do we see from a skew perspective. You know what? The skew is almost literally unched on the week. It was 3.5% bid with the calls last week, 3.3% bid this week. So it is possible we had someone coming in to overwrite those yesterday. But again, not a ton of evolution on that skew as a result. The calls also did about 1,000 contracts on Tuesday. So it was all Tuesday and Wednesday, as you would expect. And then we go back to the month that had the lion's share of the paper. We go back to October with 5 days to go, where we see the 1935 calls, a little bit closer to the at-the-money strike of around 1922. Those were leading the dance in October. They're coming in number 2 overall. 4,400 contracts on the tape there. Again, the big day Wednesday, 2,700. 1,200 on Tuesday, though, which is interesting. Not a ton today, only a couple hundred today and Monday. So most of the action on Wednesday, mostly opening there. Intriguing there, maybe someone taking a bit of a flyer there with a few days to go, picking up some upside, or again, could be over. That's an aggressive override if you are overriding the 1935 calls, but we have seen crazier things. And then right behind it, we had 4,300 as well of the 1960s. Looks like they did about 2,300 contracts on Wednesday. So it is possible that just lines up because it's Fed day and that's when everybody's trading. Or it could be there is some vertical action, 1935, 1960. It was opening on both of those strikes on Wednesday. So no roll. So it could be just your straight up 1935, 1960 vertical. Like a bunch of strikes traded that day. 2,000 of the 19 halves, 2,100 of the 2,000 calls, also all going up on Wednesday. So Wednesday, the big day, kind of across the board here, especially for the October expiration cycle. Similar size on all those days. Doesn't really look like it lines up to anything. It's not a fly. I mean, it could be, I guess, a bit of a weird iron condor opening on all, but the strikes would be strange. 1935, 19 half, and then 1960, 2,000. I suppose that could line up that way. But intriguing to the upside, if that's the case. But interesting stuff there. Again, maybe you want to give yourself a little bit more room to run if it is indeed an iron fly. We're just speculating. The paper looks similar volume-wise, but not quite one-to-one. But intriguing stuff here in the metals. But since it is Fed Week, listeners, I know a lot of you want to hear about some rates, so let's head out there next.
The Fed, the yield curve, inflation fears. How are they impacting options activity and volatility in your favorite interest rate products? Let's find out as we explore the world of rates.
All right, everybody, welcome to the wonderful world of rates. Get into that drop down. You're going to pop out of metals. You're going to go up one slot only to interest rates. And then in product family, you're going to go to U.S. rates. And then from there, where we hang out is anyone's guess. Could be 30-year. A lot of you like the 10-year, so we might head there. But before we do that, Mr. Dan, obviously an interesting week, a Fed week. What did you think of what we heard from Powell and company and the subsequent reaction in the rates, sir?
Well, I think the reaction we have in the equity market and the rate market kind of overdone, Mark. What did the Fed do? The Fed said, we're going to pause. And what was the market anticipating? Oh, the Fed should pause. And I think they should too. When the Fed makes an interest rate change, it takes 6 months to 18 months for our economy to feel it. And that's part of what we're seeing. It's part of what we're seeing at other central banks around the world. They realize that maybe it's time to stop and catch a breath. I mean, if you look at the Bank of England, they did a pause. They're at 5.25%. They had 14 consecutive increases. So we're at a spot where a pause makes sense. So I think the market was anticipating that, right? We heard a lot of talk about that. All right. And then what the Fed has said in the past is, we're probably going to have another increase before the end of the year. Okay. Then what did they say yesterday? Well, we're going to pause right now, and we're probably going to have another interest rate increase before the end of the year. Now, that's not new news. So I don't think the Fed said anything that was like, oh, my God, earth-shaking kind of news. But what it does do, it puts us in a level that the market really does start to get nervous. They're saying right now the Fed said, we're probably going to add another 25 basis points before the end of the year. So that would take us about 5.5 to 5.75. The issue there, and it's why everybody got so nervous at 5.25. In 2007, when we were at 5.25, that's when we had the real estate market collapse. Well, at 6.5 in 2000, that's when we had the dot-com bubble crash. So we're at levels that our economy in the past has responded to. So then you think, doggone it, is the Fed pushing us into a recession? Now, they also said, hold on, we're going to increase it, but next year we could decrease interest rates 50 basis points, and that'd bring us down to about 5%. And in 2024, we could decrease it to 3.9%, or in 2025. And some people say that we're going to have higher interest rates now through 2026. Well, I think we need to review what is the objective here. The Fed's, one of their jobs is to keep inflation low, unemployment low, right? Get employment high. So get the economy going. That's one of the things that they monitor. But this magic 2%, not only the U.S., is the Fed saying, 2%, that's okay for inflation. A number of other central banks have said 2%, that's our magic number. Japan, 2%, that's our magic number. Europe, 2%, that's our magic number. Now, where does that number come from? Is it statistically significant? Can we show that an economy with a 2% inflation means what? And we don't have that. It feels like it's the best guess. And then the issue is, and I think that's what we're seeing reflected here, is, well, does the Fed push this rate up to get to the magic 2% inflation? And in the meantime, the resiliency that we've seen in our economy starts to collapse and we go into a recession. So that issue, that dark cloud, potential is still hanging out there. And I think it's what we're seeing. Like you mentioned here in the notes or in the bonds, we are seeing the impact of higher yields. We're seeing this coming off. And what's interesting also is, as we know, that when the yield, starts moving up, it really starts becoming competitive with the dividend yield that you would get, let's say, in the S&P. And I don't have to take market risk. I don't have the upside and downside potential if I'm in the market, but I can get a decent yield and I don't have to deal with that. So we're also in those levels as well. And I think that's part of the impact that we're seeing in this marketplace. So to me, the Fed didn't say anything new. And there's so much talk about they're so hawkish. Well, I guess you could say some of that has hawkish overtones. But we're seeing the market response. Is it over-responding? And I think in some ways it is. So right now, though, we're seeing higher yields. We would look for decreasing prices if we're looking at the futures market. So that means in the 10-year notes, the next objective to the downside would be 108 even, is what you'd look for. 108 and a half is what you'd look for on the close of Monday or Tuesday. So we're in kind of a precarious position. I like seeing weakness in the 10-year notes and the 30-year bond in terms of their prices. And in the bond market, here's the thing I think that we don't want to see. If you're on the short side of price for the bond futures, you don't want to see 118 again. If we get that on Friday, then it's what I call an equal and opposite. That implies an up move on Monday and Tuesday and potential volatility. And what that means then is that, remember, we have that inverse relationship with yields, that yields will be coming down and we're going to see prices getting stronger. So if you are on the short side of bonds, the 118 you don't want to see. And you know, Mark, if you and I were short bonds here, the 118 would be the big adios to stand aside there.
That's
because of what it does imply. And so it's an interesting setup here. And what I'm looking for, though, is continued weakness going into this weekend. So I'd ideally like to see this closing below that 116.10 to 08 range. So potential big adios coming here, Mark.
Uh-oh, watch out. Big adios on the horizon, perhaps, for the 10-year. Where's the 10-year hanging out right now? A little bit north of 108, 108.15. Listeners off a little over a point or almost a full percent on the week. How much paper going up in the 10-year? Just to give you some frame of reference, listeners, 2.16 million contracts. So a fair amount of paper, even though that isn't the busiest we've seen the 10-year. Again, Fed week, you'd think you might see a little bit more paper out there, but intriguing stuff nonetheless. Of that, you know, the rates kind of move to the beat of their own drummer, listeners. And unlike equities or most of the other products, we're just talking about metals, they're all almost 0 day these days as well now. The rates say, you know what, hold the phone. We're going to go out to November. That's where 38% of the paper is going up this week. 36 days to go. We're going to head out there as well. The vol, again, the rates complex outside of, let's say, the old Eurodollar and now the 3-month SOFR. You get some vol there. Outside of those products, you don't really go to the rates complex for vol, and that is exhibited here by the November vol at about a 7, up about 60.6, up about 0.6 on the week out there. So decent increase percentage-wise for vol, but still, you're talking not quite a 7, 6.94 for overall vol. So it makes the VIX, what we're looking at right now in the equities, seem explosive by comparison. Skew-wise, the puts last week, 3.7% bid, so people loading up on some puts coming into Fed week. This week, 2.3% bid, so maybe taking some of those off. The calls last week, 1.3% cheap, so not much to look at there. This week, almost flat, 0.7%. So light vol, not much in the way of skew. That's kind of what we've come to expect for the rates, even though there are weekly expirations here. If you get a little bit closer to the fire, you get to the 8-day or 6-day to go contracts. Those puts are roughly 4% bid. At least they were last week. This week, that's come in as well. So it seemed like a lot of people were loading up on the puts heading into the Fed this week, kind of taking them off. So maybe no surprise there. In terms of action, I mean, the 107.5 puts out here in November, just doing banger numbers here. 136,000 contracts on the tape, listeners. So you're talking roughly 5x what we just talked about in all of silver, the entire complex, just in one option here in the 10-year, and not quite half, a little more than half of what we saw in gold out there, so pretty decent paper just for the 107.5 puts in November, listeners, and almost doing the full gold product as well in one option. 135,000 the big day today, 63,000. So post-Fed is where the action is coming in. Maybe makes some sense, folks taking some stuff off. We also saw 46,000 going up yesterday, mostly closing as well. So I'm guessing post-announcement, a lot of closing trades there as well. 21,000 heading into the announcement on Tuesday, only 3,500 on Monday. So everybody keeping their powder dry on Monday. And then looks like we drop off from there to the 108 even puts also in November, pretty much the at-the-money puts, doing 85,000. That's a big drop-off, 135,000 to 85,000, listeners. 50,000 contracts off the top like it's nothing. 2x silver just between those two in terms of difference. The big day also today, 51, almost 52,000. So a lot of paper going up out there today, listeners. 23,000 yesterday, 6,000 on Monday, 4,200 on Tuesday. Closing on Monday, opening looks like the rest of the week. Intriguing paper. And then behind that, number 3, we have actually the 108 puts. So again, the at-the-money puts. These are going out tomorrow, doing 84,000 contracts. So there is some, shall we say, near-dated paper going up in the 10-year as well. It's not all November and beyond. 86,000 of these 108 puts. The big day again today, 43,000, so pretty much exactly half of that weekly volume going up today. 28,000 yesterday, it's like mostly closing there. 12,000 on Tuesday and about 3,000 on Monday. So quite a bit of paper coming in yesterday and, of course, in the post-Fed session today out there in the 10-year. Dan, you and I have already been talking for a while here on the show. Looking at the rest of our movers and shakers, we don't have a lot of names that actually do much volume out there today. We've already talked about the beans a lot on the show, but I want to make sure, maybe if we have time, we'll get to them at the end of the show, but I want to make sure because they're not on our movers and shakers, but they are on a lot of people's radar right now. I think we have to talk about a little bit of the equities as well.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the topsy-turvy world of equities again. Are we topsy or are we turvy this week? I'm going to lean on turvy because we're in the red. Head on into that drop-down list. Again, listeners, go up 2 from interest rates to equity indexes, then head on out into the U.S. index E-mini. Dan, you said something earlier that caught my ear, and it was you think this reaction both in the rates and in the equity markets a little bit overdone, sir. Well, what's catching your eye out there in the world of equities right now?
Mark, I do. Excuse me. And maybe part of it is psychologically because I really was not looking for the kind of movement we've had for the last 2 days. I felt the market was getting what's been telegraphed. We got the script that the Fed was talking about. So it wasn't new. Are we potentially getting into areas that makes people nervous? Yes. But the reaction that we're seeing is more dramatic than I expected. The issue with that, though, is it sustainable? Now, the last 2 days we've had, let's pick the S&P, for example. The last 2 days we've had, it's unusual behavior for that market. So to see Friday closing week could, but not typical. Now, the last time we had that kind of movement was the middle of August. We had exactly very similar type price structure. what's also going to be interesting is that we're approaching swing lows. We're approaching levels that we found buyers before. So in the S&P, that'd be 43.65 down to around 43.50. That's where we've had a bounce back in August. So will those buyers come back in? Do they say, okay, the market's absorbed what the Fed has said. Now let's get back to business. This is cheap. Let's buy some. So I think if you're on the short side, that's something you got to be sensitive to. And what's also interesting, Mark, is what you and I are seeing here, not only in the S&P, it's very similar in the NASDAQ market. You know, there, if you look at levels that you and I'd want to pay attention to, like we talked about the swing lows in the S&P, in the NASDAQ market, it'd be around 14,750 down to around 14,580, right in that range. That's where buyers came in before. So nothing telling us to be a buyer with the current price action that we're seeing. If we take a look at the Dow, which surprises me, is more resilient than these other two indices that we've talked about so far. So in other words, we haven't seen the dramatic moves that we saw in the other markets. Today it is backing off. But the next level you want to pay attention to in that market is 34,300. And below that would be 34,000 even, right in that range. But the thing that when it comes to these equities, Mark, that I find really interesting, and again, I wouldn't expect this reaction, but the fact is that's what we have. It's our friend, Mr. Russell. It's, you know, the Russell is a fascinating index because it can lead these other indices. And we're seeing out of all these indices so far, that's the weakest. It's come off more. We talked about those swing lows in August for the other indices. Well, we traded below that in the Russell yesterday, and today we're even going further. The next level that we'd look at in that, well, actually right where it is, 1,800 would be a level we want to pay attention to. And below that would be like 1775. And below that would be around 1740, 1750. So there is more room to the downside. I don't see the driver for it, though. That's what kind of puzzles me. I mean, as you and I know, from a trading point of view, who cares if it goes up or down? As a trader, the direction just kind of sets up the type of trading strategy you want to do. But whether you buy or sell a market, that's not the issue. The issue is what is price doing. And right now we're seeing price here in the Russell giving us no indication of a bounce at these levels. And now let's see what happens on Friday. Do people want to go home short the Russell? I mean, it's been down every day, actually, since Friday of last week. So since then, it's been backing off. Are we going to go home that way? Or is it going to get low enough to find those buyers? If it does, what you look for is a market to make new lows on Friday, but to bounce back up. To bounce back up to about where we're closing, or where we're trading now, I should say, around 1,800. So if we got down to 1,780, for example, but we close back towards 1,800, that's an indication that buyers may be coming in, or sellers have now decided to buy and take some profit. And we don't know who's doing it. Is it sellers buying to take profit? Has it got cheap enough that buyers are coming back in? What will give us some answers to that will be Monday's action. Monday and Tuesday of next week. Do we get follow through to the upside in the Russell, or do we go sideways? If we go sideways, we have the potential for another push back to the downside. But one of the ways I think about market and fundamentals is if we think about the Fed announcements that we talked about yesterday, when we saw the market move, in a way, it's absorbing that information, right? So how far does that have to move before it said, okay, I'm done? In other words, in the Russell, to go from 1863, the high in yesterday, down to where we are now around 1800, that is how much the Russell said the S&P or the Fed announcement was. That was what it was worth in Russell points. So have we absorbed it? Are we finished? And that's why I think Friday it's going to be a barometer that we could look at to give us a clue. So I would pay attention to Mr. Russell to see if indeed what kind of action are we getting low enough to find those buyers. If that's true, and even though these are small to mid-cap companies, I would then look at these other indices to see if they follow suit. So it's interesting.
Certainly is, sir. It's funny you mentioned the Russell. I pulled it up while you were talking to see if we are seeing an explosion of paper in the Russell options right now, Dan. The answer is no. It's about half what you might expect. Usually we see maybe 20, 25,000, only about 10,000 contracts on the tape. And even weirder, with the Russell threatening to break 1,800 in the wrong direction, Dan, it's the 1,900 calls going out in 8 days that are leading the dance out there right now. Somebody opened 1,600 of those this week, and they traded pretty much every day. Not much today, but 700 yesterday, 600 the day before. So someone's opening for size on the 1,900 calls going out in 8 days. For their sake, I hope they're overriding the heck out of those, Dan. I don't know.
Yeah. Isn't it interesting, Mark, how those options give us some insights in terms of attitude? What is that near-term to long-term feeling that the market has? Even though they're going off the board, where are people trying to position themselves? And is it a fundamental driver, or is it an act of hope? And, from a trading point of view, if I hear myself hoping that something happens, I'm in a trade that's not working.
Turn around to 1,900 in about a week or so. We've seen crazier things. That's quite a rebound for all things small caps, if they are indeed. I looked for some block trades. I didn't see any block trades going up out there for those. So it looks like they were just kind of legging into those all week long. So whatever they're up to out there, maybe they're liking themselves a little bit upside. Let's go out really quickly as well into the big dog, the E-mini S&P 500 listeners. As you might expect, a pretty active week for the S&P. 3.2 million contracts on the tape, so a banger week out there. And you have your usual suspects leading the tape out there, 3,800 puts going away in a day, doing 67,000 contracts, 3,775 puts expiring in a few seconds, 50,000 contracts. So you have that normal nonsense. You also have the normal assortment of about 46% of the paper expires literally within a day. So you tack out, go out 4 days, and now you're at pretty much exactly 50% of the paper. But interestingly enough, Dan, once you filter out the kind of noise puts, as I call them, the garbage puts, people picking up their nickels in front of the proverbial steamroller, the actual biggest trade this week, and it probably makes some sense that we are shy of this level now. We were at 43.90 or so when we were firing up the tape for the show. And it's the 4,400 puts going up in about 8 days, going away, I should say, in about 8 days. So 8 days, that's an eternity in the modern equity market, listeners. No one looks beyond 3 or 4 days anymore. So going out all the way 8 days, they've been trading actively all week long, nearly 40,000 of these on the tape this week. So again, filter out the noise, filter out the nonsense puts, and this is your biggest trade in the E-mini S&P options this week. 17,000, so a little under half of that going up today, almost 18,000 actually. 7,500 yesterday, about 8,000 on Tuesday, 6,200 on Monday. So these puts been trading pretty actively all week long. The strike doesn't surprise me that much because 4,400, we've been vacillating around this range for a while. It's an important psychological level. So as we threaten it, break through it, go back above it, you're going to see some paper. That doesn't surprise me. What does surprise me is that it's 8 days out. That is a relatively surprising development in the modern equity landscape, where I just broke it down for you. 50% of the paper expires in 4 days or less. And of that, 45% really is in just a couple of days. So yeah, it's a surprising development. Dan, does that surprise you? Maybe not the strike, the 4,400 puts. I probably would have guessed something along those lines, but the fact that it's all the way out, that, dare I say it, Dan, 8 days, gasp. Who trades that far anymore?
Yeah, well, yes, it does actually. Not the strike. I agree with you. That if you look at the chart in terms of structure, that's a logical level. And plus, as you said, psychologically, it's a logical level. But the amount and that time horizon, I really do find interesting. And it also said something about how people were positioning themselves before the Fed announcement. There's a number of banks that I would deal with in Europe. And what I'd see on the trading desk as we go into like a Fed announcement or something, what you would see is the trading desk evens up. So the risk manager would say, okay, lighten up, get us somewhat neutral going into that. So they don't create too much of a bias for their book. And we really didn't see that too much. We saw a little bit of that kind of action on Tuesday before the Fed said anything. And that's also why I thought, we could have a kick here to the upside, which it didn't do. It failed yesterday. So it's really interesting, especially that's why I love what you do, Mark, because it really adds some color to, all right, what are people thinking and how are they positioning themselves? That's what's so good about what you share with us, because that's reality. It's not intent. Somebody did that. And so it shows us, all right, what is going on there? Where are people taking action? And you're right, 8 days in this market, we could have some movement.
Maybe not this much movement, though, Dan. If you want surprise strikes,
no.
Someone did open 1,200 of the 2,100 puts with 18 days to go this week as well on Monday. They opened them all on Monday. They are the entirety of the open interest on that strike. No box, no nothing else, just 1,200 of the 2,100 puts. I don't know, 2,100 in 18 days, Dan? What would be going on in the world if we were to make that strike even remotely relevant, sir?
That's a very good question.
That's beyond catastrophe. That's something else entirely out there on these. Whoever put up 1,200 of those puts, right in. I'm curious what you're up to. Speaking of writing in, it's that time, listeners. Time for a little bit of the old futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your feedback segment. We're coming up against it here, so let's go a little quickly. This one comes, I like this handle. You get the Handle of the Week award. Big Head Jack. Hope your head isn't too big. Hope we can fit through your doors there, Jack. He says, I'm looking at my quick strike right now on my screen. How do I find the TWIFO reports there. So a little bit of a logistical, technical question here. Glad to see you're using the full Bantix platform. Hope you're liking it there. And you're right. The TWIFO reports, they are available for free for all you folks over there at cmegroup.com/TWIFO. But it's also available in the full kit and caboodle Bantix offering here. And it also has a lot more bells and whistles on that version. So let's say right now we were just talking about the Emini S&P 500 there, Big Head Jack. So we're looking at that screen right now. If you look at the top tab, there's a lot of different tabs, right? There's dashboard, there's futures info, open interest. Next to that is the options info tab. I have a feeling you're going to be living in that if you're doing a lot of quick strike analysis here. Then on the left side, you're going to see a column of different categories, intraday, summary, blah, 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 blah. All the way down to the bottom of that category, you'll see something called TWIO. They call it TWIO still in there, TWIO. That's because in the early days of the show, the CME, when they put it up on their website, they kept calling it This Week in Options. So they abbreviated it thusly. And so the Bantix folks kind of ran with that, and they've never really changed it. It is technically TWIFO, so I can maybe see why you're confused. But yes, the TWIO tab is what you're looking for. When you click on that, now you're going to see everything I was talking about, everything you're going to see on the CME page, but also a whole bunch more. For example, you could click on any of these columns that we're talking about here and get more detail. You want to click on the quick skew. I always give you the quick skew numbers, listeners, but you can click on it and actually see a chart of how it evolved over the past week. You can click on the strike. You can click on the vol and get more detail on all of these things. You can also do what I do throughout the show. You can click on some of these most active options, and that will bring up a whole table showing you all the activity throughout the week, which makes it fascinating and interesting out there. So that's how, when we're doing the show, I'm able to say, oh, they opened on this day, they closed on that. That's all some of the more premium, shall we say, tools over there on the quick strike. So Jack, glad you're using it. Hope you're having a good time, getting a lot of value out of it. And let us know if you have any other questions, because it is a very feature-rich platform. You're going to spend some time on it. But if you can get to know the inner workings of it, it's a pretty useful tool. All right, Mr. Dan, once again, you and I have come to the end of another journey on the TWIFO program this week. Man, an hour flies when we're talking futures options, sir. Did you have fun today?
I did. It's always great to be with you, Mark, and there's always something happening. That's what's always fascinating to me. I'm never bored. There's something someplace in this marketplace that provides a story to take a look at, and this week's no exception.
And Dan, you can admit it to us. It's a safe space. You bought those 2,100 puts. That was you. I can tell your paper a mile away.
I would admit it if I did, but I didn't.
Well, Dan, we're coming up to the end of it here, but if there's anything we didn't get a chance to touch on, you really want to mention to our listeners now, or if they just want to get more info on all things Dan Gramza, where should they go? What should they do, sir?
Well, I do have a website, dangramza.com, and I look at 22 different markets. So we look at stock indexes, currencies, interest rates, metals, energy, and ags. There's a free video there. And if you've never traded futures, a place to begin is watch them. Just see how they trade, how they move. You'll also see red and green lines there. Green represents buying, red represents selling. These are not buy and sell recommendations, although I just got some email from people who have been using for a while. Actually, options, they wrap options around it. But the idea behind it is I just want to share how I would view these markets to provide a reference. And then we can monitor how you'll see the red and green lines move as these markets unfold. And you can go back, I think, 10 years worth of videos if you want. It comes out every day. The market's open, there'll be a video. And you can go back and see, okay, what did Dan say when this happened? What did it look like and what was happening there? And the only time you would hear from me, by the way, there's just some basic information for registration. It sits right there. I don't sell it or do anything with it. But if you want to get, it's a free daily email. It just says the videos available. And if you want that, you can also sign up for that. So those are some sources of information, I guess.
Check them out over there. DanGramza.com, the place to go to kick the tires and light the fires. I'm just trying to dig to see if I can find out what they were up to on those 2,100 puts. Listeners, it intrigues me, that one. I will keep on digging. If you want to do some digging of your own, maybe try out these tools that Big Head Jack was talking about before you commit to the full kit and caboodle. Only one place to go, cmegroup.com/TWIFO. Don't forget the F like they did. This week in futures options, the place to go to kick the tires and light the fires. You can see these 2,100 puts for yourself and a whole bunch more. cmegroup.com/TWIFO. That's going to do it for us here on the network today. Thanks for joining us. If you missed anything, of course, or if you're not in the live, you'll see it all on the on-demand side, which is why you should be definitely subscribed to the full network if you're not already. Of course, back again tomorrow, noon Central, for volatility views. After that, exclusively for all you pro folks with options oddities. If you want to check out that, of course, theoptionsinsider.com/pro, the place to go. Then back again next Monday with the option block all the way through to next Thursday and another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.